Welcome to Personal Umbrella Policy 101, PUP for short. If auto and home are the client's first line defense against losses, the umbrella is a safety net that catches everything that gets through. It is one of the highest value, lowest cost products in personal lines and one of the most underused. In California, where jury verdicts are large and home values are among the highest in the country, the umbrella conversation is not optional. It belongs in every auto and home review you conduct. Today, we'll cover what a PUP does, how it works with underlying policies, what it covers and doesn't, key terms, rating factors, discounts, and the myths your trainer will go through live. Let's get into it. The umbrella policy is exactly what the name suggests. It sits above everything else and provides an additional layer of protection. Here is how the liability stack works. When a claim occurs, the underlying policy, auto, or home, pays first up to its liability limits. If the judgment or settlement exceeds those limits, without an umbrella, the client pays the difference personally. With an umbrella, the umbrella policy pays the excess, up to its own limit. For example, a client causes a serious auto accident resulting in $1 million in injuries and damages. Their auto policy has $250,500 limits, so it pays $250,000. The remaining $750,000 would fall to the client personally. If they carry a $1 million umbrella, the umbrella covers that $750,000 gap. The umbrella requires that the client maintain minimum underlying limits on their auto and home policies before the umbrella can attach, typically $250,000, $500,000 on $100, and $300,000 liability on home. This is why writing the full liability stack together matters. The policies must work as a system. 12-month policy term, not required by law, and one of the best values in personal lines. The coverage breakdown is marked for a live whiteboard session because the follow form concept is best explained with real examples. The single most important thing to understand, a PUP is a follow form policy. That means it follows the form of the underlying policy. If a loss type is covered on the auto or home policy, it is generally covered on the umbrella as well at the excess layer. This is a simple and powerful way to explain the umbrella to clients. What it covers, excess auto liability is the most commonly triggered coverage. Serious auto accidents are the #1 driver of umbrella claims. Excess home liability covers situations like a guest seriously injured at the property, a dog bite lawsuit, or an injury that exceeds the HO liability limit. Defense costs are paid on top of the liability limit by most carriers. This alone can be worth thousands of dollars. What it does not cover, walk clients through this list clearly. Business activities are the most common misunderstanding. If a client drives for a rideshare service, runs a business from their home, or has a commercial property, the umbrella may not cover those exposures. A commercial umbrella or separate business policy would be needed. Damage to the client's own property is not covered. The umbrella is a liability product only. It does not replace homeowners or auto physical damage coverage. Let's discuss this to be sure we understand. These are the terms you will use in every umbrella conversation. A few to highlight. Underlying limits and minimum underlying limits are critical to understand before you ever quote an umbrella. A client whose auto policy only carries 5100s cannot attach most umbrella policies. You need to review and often upgrade the underlying limits at the same time you write the umbrella, which is exactly why we present it as a package. The follow form concept is the clearest way to explain what the umbrella covers. If the underlying policy covers it, the umbrella generally does too at the excess layer. If the underlying policy doesn't cover it, the umbrella typically won't either. SIR, self-insured retention, is similar to a deductible but applies specifically to losses not covered by an underlying policy. Most standard umbrella claims don't trigger the SIR because the underlying policy pays first. Libel and slander are worth mentioning because clients often don't realize social media posts, online reviews, or public comments can generate personal liability claims, and the umbrella is one of the few personal lines products that may cover this. Premium. Always give clients the cost context. A $1 million umbrella typically costs $150, $400 per year. That is less than $1 a day for an extra $1 million of protection. PUP has fewer discount options than auto or home, but the rating factors are important to understand because they shape the underwriting conversation. Multi-policy is the most common discount. Writing the umbrella with the same carrier as auto and home is almost always the most efficient approach and typically yields the best price. Higher underlying limits as a discount is worth noting because it reinforces the right behavior. We want clients to carry high underlying limits and an umbrella. Some carriers reward clients who already do this. On rating factors, the limit selected is the most direct driver of premium. Going from $1 million to $2 million typically adds only $150, $250 to the annual premium, excellent value for double the protection. Young drivers in the household are one of the biggest rating factors. A 16-year-old driver adds dramatically more umbrella exposure than most clients realize. Watercraft, recreational vehicles, and rental properties all add exposure and should be disclosed at application. Always ask the exposure question list during the umbrella conversation. Rental property, boat, jet ski, pool, trampoline, dog. Each one of these is a liability trigger. Your trainer will give you more important context to these now. All 8 myths go live with your trainer. Here's context on each. Myth 1, not enough assets. Future income is an asset. Wage garnishment is real in California. A judgment against a client with no savings but a steady income can result in years of garnished paychecks. Myth 2, limits are high enough. Even 250-500s on auto can be exhausted in a serious accident involving multiple injuries, lost wages, and pain and suffering in a California courtroom. High underlying limits plus an umbrella is the right stack, not one or the other. Myth 3, only for the wealthy. The umbrella protects earning potential and future assets, not just what the client has today. Anyone with a job, a car, and a home has meaningful liability exposure. Myth 4, too expensive. $150 to $400 per year for $1 million in protection. That is the actual cost. Present it that way. Myth 5, auto or home will cover everything only up to their limits. Beyond that, the client is personally exposed. The umbrella fills the gap. Myth 6 covers business activities. Business pursuits are a standard umbrella exclusion. Rideshare drivers, home-based business owners, and landlords need to understand this clearly. Myth 7, only homeowners need it. Renters have just as much auto liability exposure as homeowners. Anyone who drives a car needs to think about umbrella coverage. Myth 8 covers everything. Business activities, intentional acts, workers' comp, and own property damage are all excluded. The umbrella is powerful but not unlimited. Stop and discuss these together. This is the most important conversation in the PUP session, and your trainer will make it real with actual claim scenarios. Start with California context. The median home value in California is $930,000, $1.4 million in Orange County. These are not wealthy people in mansions. These are ordinary homeowners who have built equity over time. That equity is an asset that can be pursued in a liability judgment, and California courts are known for large verdicts, medical costs, and lost wages. A serious auto accident involving one person with a long hospitalization, surgery, and months of lost income can easily reach $500,000 to $1 million or more. Standard 250-500 limits get exhausted fast. Future wages. Many clients think because they don't have savings, they're safe. They are not. A judgment creditor can garnish wages in California for years. Social media liability. A client posts something about a neighbor, a business, or a public figure that turns out to be defamatory. The umbrella may be the only personal lines policy that provides any coverage for this exposure. Young drivers. Statistically, the highest risk drivers on the road are 16 to 25-year-olds. If a client's teenager causes a serious accident, the liability exposure is immediate and severe. The umbrella is the most cost-effective way to manage this risk. Get out your notepad for this next whiteboard session. Your trainer will walk through these benchmarks live with real client scenarios. The asset-based approach is the clearest framework for setting umbrella limits. Ask the client to think about everything they own: home equity, savings, investments, vehicles. Add it up. That number is what is at risk in a major liability judgment. The umbrella limit should cover it. $1 million minimum for virtually every client. Even a renter with no savings has future wages that can be garnished. The annual cost is too low to justify going without it. $2 million to $5 million for clients with significant assets, young drivers, watercraft, rental properties, or high income. The incremental cost between $1 million and $2 million is typically modest. Present both options every time. Underlying limits are not optional. Always review auto and home liability at the same time as the umbrella quote. If the client's auto policy is at 5100ths, the umbrella won't attach. You need to upgrade the underlying policy first, then layer the umbrella on top. The exposure trigger list is one of your best tools. Run through it on every umbrella conversation. Rental property, boat, jet ski, trampoline, pool, dog. Each one is a yes/no that changes the recommendation in the underwriting conversation. Always present the complete liability stack as a package. High underlying limits plus umbrella. This is how it was designed to work, and it is how you present maximum value to the client. Let's see how a real umbrella recommendation is built. 3 questions. each building on the last. Question 1. PUP check, the baseline. For clients who already have one, review the limit and notate whether the limit seems sufficient. Question 2. Underlying limits check. This is a practical skill reinforcement. Agents should be able to look at an auto and home policy and immediately determine whether the limits meet umbrella attachment requirements. If they don't, the conversation becomes, let's upgrade your underlying limits and add the umbrella at the same time. Here's what the full package costs. Question 3. The full consultative conversation. This is the most important question. There is no single right answer. It depends on the client's assets, income, household makeup, and exposures. Walk agents through the thought process, ask about assets, ask the exposure trigger list, calculate the recommended limit, present the package, give them the annual cost. Have agents practice saying it out loud. Debrief as a group. Ask agents what they would say if a client responded, I'll think about it, because they will. Great work getting through PUP 101. You now understand what a personal umbrella policy does, how it sits on top of underlying auto and home policies, what it covers and doesn't, how to set limits using the asset-based approach, and the myths you will need to address in every conversation. The single takeaway to leave with: every auto and home conversation is an umbrella conversation. You should not be leaving any client appointment without having discussed a full liability stack. In California, with its home values, its litigation environment, and its large jury verdicts, the umbrella is not a luxury product. It is a necessary part of a complete protection plan. The cost is low. The value is enormous. The conversation is simple once you know it cold. Bring your questions to your end-of-day manager check-in and get ready. You now have the foundation for all 5 core product lines. Well done.